speaker event, which is featuring none other than my dad. So he's an investment banker, which I know absolutely nothing about, but he knows lots of things. Yeah, they'll give an introduction, and if you guys have any questions about finance or startups, he ran one of those too. So, yeah.
Thanks, Jen. I'm Rick Hendrix. I am CEO of NPR Capital Markets, which is a small cap investment firm based in Washington, D.C. We have offices in New York, Boston, San Francisco, and Houston. We're about 270 people and a little over $100 million. We're a small firm. And I think, when Jenny asked me to come in and talk to everybody, and I'm going to do this really informal since it's a small group. What I thought that I would talk to you guys about, just sort of remembering what it was like in college, thinking about jobs and careers and trying to fit interviews in between all the things that were time wasters in college, is just about time frames and sort of straight lines. Right? So you guys are all here because you had sort of an entrepreneurial bug, business is interesting to you, and there's a lot more of that in your generation than there was in my generation. We were spending a lot more time shooting pool and playing basketball and playing softball and a bunch of other things. And so what has come from that is I think there's a really high degree of commitment to these early stage companies that people in the millennial generation are getting started. There's maybe 100 companies in the United States that can get away with being a startup and not making money. Right? They have an idea that people really want to put a lot of money behind, and so whether you are Snap or Google when it was in the early days, or any of the big social media platforms, and those things didn't make money for a long time. Amazon, as you know, still doesn't actually make money. There's about this many companies that can get away with that. Right? So almost every other business in the U.S., whether it's small, whether it's big, has to generate a profit, and that is, that's not the easiest thing in the world to do. So I'm going to backtrack and sort of give you a little bit of my career, and then we get into Q&A. But one of the things that I want to leave you guys with is that to get a business from a garage, right, onto stock exchange or to a place where you can sell it for real value, it takes a long time. Right? The idea that you're going to have the next idea that big venture firm comes in, puts $1 billion valuation on, and it's off to the races. Like, it happens, right? You see it, and it gets celebrated in the press, and you read about it. That's a little bit like the lottery. And I would tell you that somewhere in here are not just one person, but 3 or 4 people who are smarter than the people who started Snap and started Google and started Facebook. Right. So look, they worked really hard, they had great ideas, they were super smart, and they never stopped in the early days. But they weren't any more capable than you guys are. There was a little bit of a lottery element to that type of success quickly. And so it may happen, right? But you really need to prepare to build a business that's going to be profitable, that's going to let you pay the bills while you grow it. And it may be that it's 10 years, 12 years, 15 years, 20 years, and you may be on your 5th product, your 5th idea, before you really get to the level of success you're looking for. And that would make you an A+ in the class. Okay, so I think that there's an expectation, particularly if you have a good idea and you have an idea that attracts a lot of attention, that immediately you sort of jump to venture funding and preparing for an IPO. There's a lot more that goes into it, and it's a long time, and it's definitely not a straight line. Right? So we have a lot of clients at FBR who literally get to their 5th or 6th business idea within the same corporate structure, or 5th or 6th application for a particular technology in the same corporate structure before they ever find a way to make money. And that's normal. That is much less the outlier than the unicorn, $1 billion it's a really small slice of corporate America. So let me back up and give you a little bit of my background, and then we can talk some more about sort of what's going on. I think in startup community, differences between startup companies and big companies, because there are big differences, as you guys all think what you want to do when you leave Northwestern. Those are real choices, and they're different choices. They all can end in the same type of success, but again, now you're talking about these not straight lines, right? That you sort of meander all over before you get to the end. So I was not as smart as any of you guys, so I didn't go to school quite as good as Northwestern. I went to Miami, Ohio, and when I graduated from there, I took a job with Pittsburgh National Bank, which is now PNC Bank, and it was in a really traditional sort of management training program. While I was at Miami, I shined shoes, literally. So, I've had a wide range of job experiences over my life. At Pittsburgh National Bank at the time, I started working with big corporates in Pittsburgh, and you guys won't remember this, but in the 1980s, Pittsburgh was the biggest Fortune 500 headquarters city outside New York. So you had U.S. Steel and PPG and Alcoa and all of these big industrial companies that were centered there. So it was a great place for somebody young who was going to cover big companies to sort of start a career. We were also, as a bank, buying a lot of small banks around the country at that time. And we bought a bank in Cincinnati called Central Trust, and I moved down to Cincinnati with a small team to sort of make that bank part of PNC, or Pittsburgh National Bank at the time. In that process, we learned pretty quickly that our acquisitions team had not done quite as good a job as they had in some of the other acquisitions, and we really had bought a bank that shouldn't have taken over by the government. So it was full of bad loans. It was clearly insolvent. And so we spent the next 4.5 years basically cleaning up that bank, restructuring loans, foreclosing on companies, locking corporate aircraft in hangars, and doing everything we had to do to basically recover the money that had been loaned by the bank. And after that, I went back to Pittsburgh into our investment banking area, and we talk about not straight lines. I went from being a credit officer and sort of workout person down in Cincinnati to starting our asset-backed and securitized finance business in Pittsburgh. And this was in the early 90s, early mid-90s. So it was a very new technology. What you guys may see if you've taken any economics or finance courses in terms of securitization today, it was all being created back then. So starting business in a really new area of finance was interesting. A lot of the clients of that business were small banks who had auto portfolios, mortgage portfolios, credit card portfolios that we were securitizing for them. And so I started doing a bunch of bank M&A in addition to the securitization work. And then in the late 90s, we PNC bought 5% of FBR, which is where I am today. It was a time when all the big banks were acquiring broker-dealers. So when B of A bought their original, Bank of America today is a very different animal than it was 20 years ago, but there was a bank in North Carolina called NCNB that bought a broker-dealer by the name of John Stevens. Bank of America bought a group called Montgomery Securities on the West Coast. Ultimately, Bank of America and NCNB merged, and so there was a lot of that activity going on. And so rather than actually acquiring an investment bank when I was in Pittsburgh, we made the small investment in FBR, and I moved down to Washington and have been there since, working on IPOs, big equity private placements. But through that process, or while I've been at FBR, even that has taken some interesting turns. So Jenny mentioned that I worked or ran a startup for a while. We actually backed in the early 2000s, sort of in the tech bubble period, a handheld electronic prescribing business. And there were about 3 or 4 of these startups around the country. FBR backed one of them. We put in $3 million, $3.5 million, something like that to get started. It was the best technology platform in the industry. Had sort of cracked the code on how to deliver what's called formulary, which is someday when you guys get out and have your own health plans with whatever company you work for, there are certain drugs that are prescribed for a condition, and your insurance company will say, you know, I want my patients to get, or my clients to get Lipitor and not Zocor, whatever the equivalent drugs are. That's called formulary. So this company had sort of cracked the code on how to deliver them in the doctor's hand based on who the patient's insurance company was. So in any event, we put the money up, and 6 months in, they ran into real trouble. They didn't need $3 million, they needed like $30 million, and so I actually stepped in as CEO of that business, ran it for about 15 months until we were able to get it sort of over the hump. You know, that's a very different process than being an investment banker or working for a commercial bank, I can assure you. And you know, look, some of the differences between a startup and a big company are, you know, while I always knew that I was going to go back and run investment banking at FBR whenever I got this thing cleaned up, every other Friday, you know, I was trying to figure out how we were going to pay for it. And that is, when you hear stories like that about startups, that is absolutely true. And there was one Friday when I just wrote a check, not from FBR, not from any of our other investors. I just wrote a check because we were not going to be able to pay. And we had investors because there were a lot of people who really believed in this company, particularly locally in Cincinnati, which is where it's based, who would come in and every 2 weeks buy stock. And we finally got to the point where we said, you know, we can't sell you any more stock because we're fairly certain this company is not going to survive. So, you know, you're selling stock that's going to be worthless. And these doctors who believed in it, and some of the local business community who really believed in it, they would basically write you a check for $150,000 and say, you know what, don't worry about it. If the business doesn't make it, I'll feel good that I tried to make a difference, and you know, they buy more stock. And so, you know, when you're talking about really little companies, and little companies that you're trying to get over the hump, it's a whole different set of you know, considerations, decisions, risks. You know, at the end, every one of them, whether you're JP Morgan or whether you're some little startup out in San Francisco, they all play a really big role in their communities. They play a big role from a societal standpoint, and understanding the differences, I think, is important. And one thing I would tell you is that if you have the chance to work at whether it's a big consulting firm or a big investment bank or big marketing firm or Procter & Gamble, and you know, one or more startup opportunities, I would do all of those things. There are very few careers that, you know, don't sort of take this tack to right and left and backwards and forwards before they finish. And I think, you know, people that manage that process well end up really well rounded, really valuable, and it's an important part of building a career. I mean, you know, if you look at somebody like Jamie Dimon, who runs JP Morgan today, Jamie Dimon's early career was, you know, basically buying and running little tiny finance companies for Sandy Weil, who ultimately then, you know, basically rolled that into an insurance company called Travelers, which then was acquired by Citigroup, right? And then he and Jamie had a falling out. Jamie left, ends up at Bank of Chicago, which gets acquired by JP Morgan. And even the people who were sort of at the pinnacle of their industries and big industries, they have taken, you know, not a straight line from sort of start to finish. And so I think, you know, again, just sort of coming back with time frames and straight lines versus, you know, sort of moving all over the map to get to, you know, what you're looking for out of a career. Everybody needs to understand that there's only, you know, there's one Bill Gates, even Warren Buffett, I promise you, has a lot of, you know, forward and backward and side to side to get to where he is. Berkshire Hathaway in 1985, nobody ever heard of Berkshire Hathaway. Right? And today it seems like Berkshire Hathaway is just a fixture in American business. You know, there have been some bad deals along with Berkshire Hathaway. Warren Buffett put a lot of money in Salomon Brothers, which was an investment banking firm in New York that he basically lost all of. He was stepped in chairman of Salomon Brothers. Nobody remembers those things, right? Because he's now sort of a celebrated business hero, as he ought to be, because he's amazing. He's created unbelievable value for his shareholders. But that was not a straight line. There were a lot of detours along the way. A lot of steps forward, a lot of steps backward. So I'm going to stop there. I have a whole bunch of things that I could go through with you guys about careers, about people I graduated with who took some really strange detours that ended up in great places. But what I really wanted to do tonight as much as possible is answer questions, because I certainly don't know what you guys are thinking about the way you do, and as long as I'm here, we'd love to answer it up.
Can you just give a little more detail into what FBR does exactly?
Sure. So we are a small cap investment banking firm. There aren't that many, sort of what I would consider monoline small cap investment banking firms left. The business is a lot tougher today than it was 10 years ago, 20 years ago, 30 years ago. I think if you're going to be a small or mid-sized investment bank and be independent, you have to do something that is differentiated. And what we do that's very different is that we do really big institutional private placements, and we have extraordinarily high market share in that business. It's a small business. I mean, there are literally years where, and this year may turn out to be one of them, where we won't do a deal that looks like that, and yet, let's say our business model is built around $180 to $200 million of revenue annually. Well, every time we do one of these big institutional private placements, we generate something like a $30 to $40 million fee. So if we don't do any of those, that's really bad from a business model standpoint. So we have really high market share there. In that particular business, we don't compete with other small firms. We compete with Goldman Sachs, we compete with JP Morgan, we compete with Credit Suisse, and we have more market share than any of them. And in fact, if you go back to just pre-crisis, each of those firms, along with Morgan Stanley, tried to start a business just to compete with this 144A product that we spent so much time on. While Goldman did a couple deals, we got into 2008, 2009, big dislocations in capital markets, and they shut the business down, as did Morgan Stanley, as did JP Morgan. So little mighty FBR just sort of continued on its way, and there were no deals like that done in 2008, right, because that was the year of the financial crisis. We didn't do, we went 20 months, almost 2 years without doing a deal like that, which is the biggest part of our revenue stream. And then we did 3 of them between October and December of 2009. We went out and raised, I think, a total of $3 billion for 3 different management teams to go buy failed banks from the FDIC. And so for a small firm, 270 people, a sales force of 30 institutional salespeople, to be able to raise that kind of money, that's sort of what's differentiated about us. Now, I will tell you, those of us who've been there a long time and have built careers there, we sort of are used to it at this point, but the volatility of a business like that is crazy. And so, in 2013 and 14, we made more money than we ever had before in the history of the company. And as I said, 2016 looks to me like a year, and we're sitting here in the middle of November, where we may not do one of those big deals. I think we're going for the services deal in December. But we're pretty unique in that we're still independent. We almost look like an old British merchant bank in the sense that we don't have a big balance sheet, we don't lend to people, we don't have a retail business, so no individual opens an account with FBR. Our clients are all big institutional money managers on the buy side, and depending on what industry we're working in, small to really large clients on the issuer side. And so the bank deals that I mentioned, those are big deals. A couple other sort of notable deals that we've done over the last few years. There's a gentleman by the name of Steve Hazy. Anybody other than Jenny and I from the Washington D.C. area here? Okay. Well, there's a Smithsonian Museum in Northern Virginia called the Udvar Hazy Museum, and Stephen Udvar Hazy is a guy who started the aircraft leasing industry. Literally started in college. He was fascinated with airplanes. He bought a little single prop airplane, started leasing it to guys who used it as a prop duster out in California. And from there, so you talk about startup, built himself into a $2 billion market cap company that sold to AIG in the late 70s. And in 2008, he was the second highest paid executive at AIG when the government took AIG over. And he decided it wasn't going to be a lot of fun to, given his background, get paid $500,000 by the government to run the biggest aircraft leasing business in the world, which is what AIG owned it. And so he left, took his management team, came to FBR, and asked us to raise $1.2 billion so that he could start a new aircraft leasing business in early 2010. And so we went out and did that, and today Air Lease is a $5.5 billion market cap company, and they are the number 2 aircraft leasing business in the world, to ILFC, which was his original business. And then more recently, I don't know how familiar any of you are with what's called the single-family rental business. But coming out of the crisis, there were a huge number of foreclosed homes. Right? There was a lot of questions just from an economic policy standpoint about what we were going to do to sort of clean up all of these foreclosures and sort of get this housing stock back into sort of the functioning part of the economy. And as always happens, fortunately, some entrepreneurs said, you know what, this is the time to go buy houses in the U.S. at stress prices. We know we can't sell them, but we can turn them into rentals. And so the entire industry has emerged out of the crisis, where there are today, there's really 3 dedicated public companies that are doing it. There are 2 really big private companies. One of them's here in Chicago. I met with the CEO earlier today. The other private one is based in Dallas. It's owned by Blackstone. It'll be going public sometime early next year. But we raised about $2.5 billion for a company called American Homes for Rent that was backed by a gentleman by the name of Wayne Hughes. Wayne today is amazing to me, but he's 85 years old, which means when we raised the money for him 4 years ago, he was 81 years old. So we're talking time frames. Now, this was his second act. He'd had a lot of success previously. You guys have all seen public storage locations, self-storage centers. He started and built public storage, okay? And then he retired as chairman and was looking for sort of his next act, which was single-family rentals, and so we raised a couple $2.5 billion for Wayne to start that business. So those are the kinds of things that we do that are different. But look, when you build your business around big transactions like that, it just comes with a lot of risk, right? So you have to have the stomach for a lot of this. And we're a public company, so I spend a lot of time educating investors about what we look like in the ups and in the downs. And I've been at FBR since 1998, and I would tell you that I personally, company's about 10 years older than me, it's about 10 years old when I got there. I've been through at least 5 of these cycles. Because our cycles seem to be more frequent than the general economic cycles, but everybody there loves the business. None of us would want to do it off a bigger platform, and to take a little company like that and do really big things, that's what makes everybody tick is a little bit different. What makes most of the senior guys at my firm tick is that, right? They want to work off a small platform and go beat Goldman Sachs, beat JP Morgan. You can't believe how upset those kinds of firms get when a little firm like us generates a $40 or $50 million fee. Right? because they believe they own that business, and nobody has the right to a $40, $50 million fee other than Goldman Sachs, Morgan Stanley, or JP Morgan. And a lot of people sort of take pride in having a lot of market share in that kind of business.
What do you attribute to like those other bigger banks not being able to compete?
It's not capability. They are very capable. It really is just what their business is set up to do. So when we do a transaction like that, it's our institutional sales force. And so this is a group of men and women, it's like 30 people as I mentioned, who their clients are Fidelity and Wellington, T. Rowe Price, Capital Group, and UBS O'Connor. I mean, all the biggest asset managers in the world. And so when we bring a deal like that, we will take the entire sales force and we put them in a room. We'll put them in a room 5 or 6 times over the course of 4 or 5 days to do really intensive teachings about the business. That probably is collectively 8 or 10 hours. Well, what that means is we're taking our 30 salespeople who are supposed to be on the phone talking to clients every minute, every day. I mean, our trading floor looks like something you see on TV. And we're taking them off the desk and therefore giving up whatever revenue we would do in just regular trading activity. So for a firm like ours, our trading business is maybe $40 or $50 million a year revenue. Right? Well, we can, in a bit, not all the time, but in a big transaction like I just described, we might do a $40 or $50 million fee just on that one deal. So for us, business model-wise, it makes all the sense in the world to take those people off the desk and educate them on this particular opportunity, and then tell them that for the next 2 weeks, we don't want them to do anything other than talk about airways. Or we don't want them to do anything other than talk about American Homes for Rent, or more recently it's been energy deals. We don't want them to talk about anything other than Fairway Energy, or NVEN, or Select Energy, which is the next one we're about to do. If you're Goldman Sachs or Morgan Stanley or any of the big firms, the give up, because if you're Goldman Sachs, you still have to do that if you want to actually execute one of these deals. Because the amount of time it takes to convince a portfolio manager to buy an illiquid security, so that if their boss happens to walk by the next day and say, why do we own $20 million of this thing that I can't trade? And if you buy an IPO, right, and somebody up the chain doesn't like it, you push a button and you sold the stock and you're out. And you might be down 10%, 15%, but you're out. If you buy in a private placement, you're there for a while, right? And so it's a high bar in order to convince somebody to make that investment off of an institutional desk. So again, whether you're FBR or Goldman Sachs, that's hard work. For Goldman, the give up in revenue to do that level of teaching, to spend that much time on one transaction, is just too big. So it's really a business model issue. It's not that they have, I would kill to have a lot of the talent they have. So it's not that, I love everybody in our firm, and I think they're fantastic, and I can point to 2 or 3 people who I think are better than anybody Goldman has, but it's not like everybody at FBR is better than everybody at Goldman. That's definitely not true. Right? Pound for pound, they've got more talent.
So this is actually kind of switching gears a little bit. You talked a little bit how you had experience in the healthcare industry, and that's actually a space I'm interested in. I'm curious, as someone who's started outside that space, what are some of the challenges specific to that area? Did you see a lot of it in your show when you were trying to get this electronic device implemented?
Yeah, doctors are terrible clients. They really are. I mean, doctors are brilliant people. They have, a really important high calling in life, right? But try to tell them what they have to do to document what they did with their patient or how to do something, and they have zero interest in hearing. So, getting insurance companies who are ultimately for the healthcare system the good payers, getting insurance companies to somehow get practitioners to change what they do. That's been a multi-generational struggle within healthcare, and it still is a struggle today. Now, like everything, right? You have a lot more tech-savvy doctors being created today than you did 10 years ago, 20 years ago, 30 years ago, because everybody's growing up on a computer, and it would be, hand probably a newly minted 30-year-old doctor a paper pad, and they would look to you like, what do I do with this, right? And so, as the economy comes along, as technology gets more introduced into society generally, it's getting easier to influence behaviors of positions. But the biggest thing about healthcare is that it's just a world unto itself, right? There's very little within healthcare that looks like any other industry. So it's not easy to just sort of parachute in and have credibility with owners of healthcare businesses or practitioners. A little easier with insurance companies because they're sort of financial business people. But when you start talking to somebody at a really good biotech company or a really good medical device company or even a home healthcare company or like a hospice company, I mean, the healthcare practice is so specialized and it's so much more patient-focused first and sort of profitability second, that it's just a different world. And I know people that have been able to migrate across and do a good job, but I'd say that's the exception rather than the rule. So if healthcare is really interesting to you, I would definitely try to start somewhere in healthcare because it's a tight-knit community. I mean, even the sales reps at McKesson or Cardinal Health or the big drug distribution companies, they know the people of the technology companies, they know the people of the insurance companies, they know the administrators of the hospital systems. It's a big community, but it's its own community to a large degree. Much more so than financial services or energy's a little bit that way, but energy's even easier to sort of slide in and out of healthcare.
You talked a little bit earlier about your market being highly cyclical and very volatile.
Yep.
Can you talk a little bit about maybe some factors that influence either an up or down market that you've seen?
Yeah. Well, there are a lot of them. This is actually, it's gotten a little bit of press recently, but I would say because the equity market has been hitting new highs pretty consistently over the past, certainly over the last week. But see how long it lasts. But all year long, we've been bouncing along sort of 5% below all-time highs. People would say, well, what's wrong with the market? Well, this is the worst year for IPOs in over 20 years. Right? Now, that's unusual when the market is hitting new highs consistently. And there are 3 or 4 things that are causing that right now. And these kinds of big shifts happen frequently. Right? This is not all that different, other than every time it's different because it's not the exact same sort of loop. But if any of you have read about passive investing versus active investing and all of the money going toward passive investing, when I say passive, I mean ETFs, index funds. It's basically, and you've probably heard the term robo-advisor, that has become a default approach to investing for a lot of people, and even for big institutions. Right? So when you go through a period like we had, but the crisis from my perspective hasn't really ended, even though we've had big recoveries in the market and we've had big recoveries in certain industries, we still have huge distortions in terms of leverage in the system. We've moved it out of the private sector onto the public sector balance sheet, but it's not gone, right? So we're still living in this world of big financial distortions. Part of going through what we did in 2008, 2009 is that people basically say, look, I don't want to pay 1%, 2%, 5% to have my money managed if when we go through a crisis it was 30% anyway. Right? And so there's been a lot of money that's gone to these ETFs and index funds. Well, ETFs and index funds do not invest in companies. Okay, what they do is they buy stocks. And there's a big difference. The action is the same in terms of handing over cash in exchange for security, but investing in stocks is or buying stocks is very different than investing in companies. And so we have a smaller subset of the capital markets that actually can make active decisions about IPOs. So there's just less capital available. And we have pushed valuations up within the big indexes for sure, but I'd say anything in the Fortune 1000 and up, the valuations are ridiculously high. It's because people aren't making active investing decisions. They're just saying, I'm going to buy the S&P ETF. So, $1 billion flies into the S&P ETF. they automatically go buy whatever's in the S&P, and it just takes prices up without any particular governor around, is that company worth what we're paying for it? So you have this big spread of, valuations up here for the big companies. That's how you determine what a small company's worth. So, take, small E&P company or energy exploration and production company, energy. Let's say they have a $500 million market cap. You're going to basically determine what they're worth based on what Exxon is worth. Exxon, Shell, and everybody else. Well, Exxon and Shell traded, actually infinite multiples of earnings right now. They're not making any money. They can't cover their dividend. And yet no smart investor is going to pay more than 6 or 7 times cash flow for this small little E&P company that operates in the Permian Basin. Maybe if it's in the Permian, we'll go with that. In the Bakken, up in the Dakota. And so there's this huge spread between valuations. So, the sellers don't want to sell at what they view as a depressed price. Smart investors aren't going to pay what these big companies are trading at. And there's less money available because all this money has moved over to passive investing. So that's a big part of what's going on in the IPO market right now. If you go back to 2008, it's something totally different, right? We hit I certainly hope, once in a multi-generation financial crisis, and there was massive wealth destruction. And so nobody who had a company that they would take public felt like they were going to get fair value for it. So in that case, it was a purely seller sitting on the sidelines because they weren't going to sell at 2 times cash flow, 3 times cash flow, or whatever the public company was selling for. So there are different reasons each time, and normally it's industry specific. Normally it isn't the whole market. This time it's actually been the whole market. And it's really been this way for about 3 or 4 years now, which is why I say that the crisis from capital market standpoint really isn't over. This is the worst year in 20 years for IPOs, but if I took out all the biotech IPOs from 2014-15, it would be the worst 3-year period for IPOs in the last 30 years. So there's a structural thing going on in the capital markets that is causing it to be more difficult. And by the way, private equity owns a higher percentage of corporate America today than any time since the 1920s. Right? So there is money out there for somebody who starts a business, needs capital, wants, quote, a fair valuation. Now, I have a lot of good friends that run private equity firms. I am not a private equity believer because I think that controlled capital like that typically stifles growth, and they try to generate their value through balance sheet restructuring and sort of things other than growth. I've had a private equity firm that owned 20% of our company for 7 or 8 years, and they're really good friends still today. They were on the board for a long time. But private equity is they make a lot of money for their investors. I'm not sure. There's exceptions to everything, but as a general rule, I don't think that's particularly productive capital. I think the public market is much more efficient and a better place to go for business owners to capitalize the business because you're not bringing in control investors, right? So you're going to stay in control of your own destiny. If you took the business all the way to the point where you could take it public, in most cases, that strategy is the one you want to stay with. You don't typically want to hand it over to KKR and let them, throw 5 MBAs at it and decide that it'll be something different than what you built. And there's a lot of that that happens. In fact, one of the reasons we do these big 144As I mentioned, so Steve Hazy, who I talked about this aircraft leasing business, his alternative was private equity from Blackstone and KKR. Well, Steve Hazy's 68 years old. He's already run a public company. He's been the number 2 executive of the biggest insurance company in the world. Why is he going to have 3 or 4 30-year-old MBAs on his board telling him what to do? Right? That's not the kind of capital that he was looking for. Most CEOs or entrepreneurs don't have that level of experience. They don't know it, right? And if you think investment bankers are good salespeople, the really good guys at the private equity firms, they're bad, right? And they will convince you want to sell them. And it isn't. It's no different than any other sort of business. I mean, it's about getting access to the best opportunities, selling really hard to get them to take your money so that you can generate a big return for investors. And if you're in the private equity world, you're taking a big scrape off the top in something in the 2 and 20 realm, which means they're making 5 points on their capital. So that means 5% before people only pay 5%. That's the private equity fee structure. If they're good.
I was wondering, so when the startup really started hitting the hurdles, some big hurdles, when you had to write a check to cover payroll, and when you had to potentially turn away people who wanted to buy stock, how were you thinking? I guess what were you telling yourself to stay in it and not throw in the towel necessarily during those times?
In terms of writing a check for payroll, I had reasonable conviction that we were going to get around the funding the next week, but didn't know for sure, right? So I wouldn't have done it twice, but look, I knew a lot of it. I didn't start the company, but I've been there long enough. I knew everybody. If there's a way to make payroll, you're going to make payroll, right? And so it just was the right thing to do, and fortunately it worked out, at least for a short period of time. I think you just have to sort of believe in what you're doing. And by the way, shutting down a business is not easy, right? So sometimes you just keep going forward, because going backwards is worse, right? So if when you think about particularly a startup that's had 20, 30, $40 million invested in it, when you go to shut that down, that's probably going to cost you $5, $6 million, right? Even if you use bankruptcy as sort of the avenue. So going backwards isn't necessarily any better than sort of going forward. And I think a lot of times it's as simple as that, right? So even running FBR, or even when I was with Pittsburgh National Bank, we were down in Cincinnati trying to fix the broken bank down there. You see some really dark days. When I was in Cincinnati, there were some really dark days. And it wasn't like, I didn't think I was going to be able to pay my own bills the next week. But, I really wondered whether that bank was going to survive or get taken away from us who had bought it by the government, or, whether, some of the people who were working there were going to go to jail. We had a guy come in and basically break down and tell us that he'd been embezzling from the bank for like 3.5 years. Because his wife had MS, and his special needs son, and he couldn't be in. It's like, these aren't people that are, people get desperate and make bad decisions, but when you get into tough situations, you see everything, right? And those are tough days, and so continue to move forward through that, whether it's because you don't think the money is going to be there, or you think that, there are, legal issues that are insurmountable. I think you just sort of have to have tunnel vision, and you're sort of focused on getting from here to there, and it's the next day, next meeting, next day, next week, next payroll, and you just keep going forward. And look, sometimes that's not the right decision. There are times when, particularly so this Pocket Script, this company in Cincinnati, we ultimately shut it down, and we shut it down because the question about physicians and how do you get them to do things, it wasn't just Pocket Script. There were 3 others. There was iScribe, Parkstone, and Allscripts. So there were 4 companies that were all pursuing the same business model at the same time, and one of them survived, Allscripts. They ended up buying Pocket Script technology later because it was the best technology. But we ended up shutting it down because we just couldn't get to a place where we were going to be consistently profitable. And I think we would have ended up with $300 million invested before we got to profitability. And so that one was one you just walk away from. But you try to walk away from it in a way where you've got hired on salespeople, and you've got coders and everything else, and you want to do it responsibly, right? So that doing it responsibly is expensive. And I think, because a lot of entrepreneurs are bootstrapping the whole way, and it sounds a lot more romantic than it is. they don't have the ability to be positioned so that they can shut it down responsibly someday. And that is something that if you're gonna start your own business, you should always have in the back of your mind. And that's one, I see people go out and hire way out in front of revenue frequently. And whenever I see that, I tend to shy away as a banker. Because I think those people aren't really thinking through what they're doing. Right? You bring on 30 people and you don't have the ability to generate a profit, you better have a lot of cash in the bank. Because you don't know if you're going to be around for 3 weeks, and you can't just lock the door and say, thanks, see you, right? So there's a cost, whether it's severance or whether it's continuing health care, or people are expensive. Right? They are. The fewer people you can have in a business, this is terrible, because I don't even believe in this from an employment standpoint, but the fewer people you can have in a business, the simpler it is to run, and the safer it is to run.
Yeah, so on a much lighter note, you've transitioned from a lot of different roles in different industries, and a lot of them are really different. So I'm just wondering if you have a way of learning or systematically picking them up or bringing yourself up to speed. That's what it's been to share.
That's a good question. I wouldn't say I have a system to do it. I really, I love what I do, and I have sort of every step, so I'm really lucky, right, because everybody doesn't have that experience, but sort of every step along the way, I've really liked what I was doing. And so, for me, it's always been just a matter of sort of jumping right into the middle, and I was always willing to ask questions about anything I didn't understand. And that's a really basic thing, but I think it's important for everybody, because if you don't understand things at a really basic level, let's say you get dropped into a new sales role or a new product area in a company, and maybe you know the jargon, you know the conversations to have with clients, but if you don't really understand what's going on at a basic level, you're going to make mistakes. And so, I think, particularly when I was younger, it was probably really annoying, but I just asked a lot of questions. And I think the more questions you ask, number one, the more you're going to learn, but 98% of the time, people view that as being really earnest and focused and wanting to do a great job, and so it's almost never a negative. And sometimes it takes a long time, and there are other cases, when we were building the securitization business, everybody was sort of making it up as they went. Right? It was like every single deal, somebody was adding some new feature to, and so to be able to do that, you have to really understand the basics. You have to understand exactly what happens if somebody defaults on their credit card bill. Not, we lose money. How much does it cost to go to court? How much does it cost to send it out to a collection agency? What are the collection statistics? What's really going to come in? It's really basic, granular stuff. And if you understand all that, then you can figure out, well, okay, look, we can do a 78% advance rate against this portfolio and get back then a AAA rating. But maybe if we are willing to put cash into a reserve that will cover 60 days of delinquencies, we can get 85% advance rates, another 8%, we want to put 2% in the cash reserve, and so all of a sudden, we just generated 6 points of capital for whoever the seller is securitizers. And so those kinds of things you can't do unless you really understand the real basics. And so I guess I should thought of this way before, but I think just in every one of these roles, and even today, I ask questions all the time. I know exactly from point A to point Z what happens in an IPO. I know what happens in a good IPO. I know what happens in a bad IPO. I know what happens when you're the investor and you make a mistake. I know what, because we've just done it for so long. But I still, in every single deal that comes to the committee, you ask the same questions over and over and over again. And invariably, you'll get some answer that's different than it's supposed to be. And then you have to go back and figure out why. And sometimes things are different, but most of the time somebody just missed something. Right? And so understanding things really thoroughly is, I think, is really the recipe for it.
What would you say has been the most rewarding role you've held?
You know, I probably the most rewarding role has been when I've been the the investment banker sort of on a particular transaction where we really made a difference. And the thing I miss in what I do now is, you know, I get involved in the marketing process up front. I, you know, have dinner with the management team when they come in to present. I'm on the phone when we're talking to them at the end. But I'm not really sort of sitting with them, you know, every step of the way when we do a deal for them. And so when you're doing that and you know, you see how you're either creating value or transforming these businesses and you know, just because of the relationships that our firm has, we're able to raise $500 million for somebody to allow them to make a big acquisition or starting a business or take out a control investor, whatever the use of proceeds might be. When you're actually the banker doing those deals, I think I'm just sort of a deal junkie, right? So I mean, you sort of, that's a very rewarding process. And look, anytime you win a big piece of business on the front end, if you have any salesperson buried deep inside you anywhere, and when I was coming out of school, the last thing I thought I would ever be is a salesperson. But when you win a big piece of business, particularly when you win a big piece of business against the Goldman or Morgan Stanley or something, that's, you know, I'm sure that what you know, what we do every day, and you know, we look at our 270 people. There are, at last count, our 270 people, I think, have like 230 kids. Right? That's a much bigger deal. That, you know, they're going to good schools and, you know, have health care and they've grown up with a good life. I mean, that is probably a high level psychically more rewarding, but that's not the same as winning a big piece of business. You win a big piece of business, for like a $30 million figure or something like that, that's good feeling.
I have an advantage because I live in the community, so I get to pick your brain about other things. But I have two questions, and I'm going to give you the second one beforehand because it's probably hard. So first question is, what did Allscript do right that PocketScript didn't? And I know PocketScript is early, but I have the advantage of knowing that technology is being used now. And so what did Allscript do right? How often do you have to evaluate whether or not a company is just like early when you make that decision? And then two, the one that you'll probably think about is, what is the coolest company that you've invested in, and what did they do and why?
Allscripts, which was the surviving company out of those four, it had two big advantages. It had capital advantage, it was already public. So it had much better access to capital, lower cost of capital, and it was more diversified. So Allscripts was evolving out of another business. So I talked at the very beginning about people being on like their fourth or fifth iteration of product usage or business model. That was Allscripts. They were on sort of their fourth generation of trying to get technology in the doctor's offices. So they had a presence in those offices already, and they had a big capital with them. And that's really why. I mean, they ended up using the PocketScript technology, right? So the guy who wrote the code, and they were writing code every day because his formulas change all the time. There's no question PocketScript had the best team, the best code, the best technology, and Allscript was very happy to buy it for not much, somewhere down the road. You know, I don't know, the coolest company that we've ever worked with. I don't know. I think I don't know about coolest company. I think one of the coolest deals we ever did back in 2004 maybe. There was a subprime auto company, which actually is now GM's auto finance arm. So when we went through the crisis, GM had to spin off GMAC, and then 3 years later they bought an auto finance company that had been a subprime auto company for a couple of decades, and we did a deal for this company that Everybody thought it should be bankrupt. It was on CNBC literally every morning for like 20 days in a row. This company was going bankrupt. Well, we were out in the road trying to raise money for these guys to get them recapped. And this is a case where just knowing things really thoroughly was the difference. So we were the only firm that had actually done the work on what was going to happen to their securitization trusts from a cash flow standpoint if they hit these loss triggers. And we just assumed they hit them all. We said basically just count this portfolio as zero, right? Just assume everybody's going to default. We can't go repossess any of the cars. And we did all that work and basically were able to show investors that there was still positive economic value to the business. And so we went out and raised $500 million. And every other bank that was talking to me said, no, let's raise $50 million and that'll get you through like the next 6 weeks. And then we'll figure something else out, We said, no, that isn't gonna work. So you're not gonna make it through 6 weeks. You're going bankrupt in 3 weeks unless you do this. So we raised $500 million, basically recapped the whole company, so 98% of the company in the offering. And I remember sitting in the lobby of some of the investors that were doing investor meetings, watching the guys on CNBC say that Americredit was going bankrupt like that day. You know, I mean, we'd go walk in and these portfolio managers looked at us like we had 3 heads, but we're able to take them through, you know, the math. And the math was, if we'd raised $500 million, this company was going to not just survive, but get back on its feet and thrive. And it was the highest quality player in the space. It just had a bad balance sheet. And we got it done. And you know, the talking heads, you know, basically, so everybody back then, 2004, they thought that we raised all of our money like in the Middle East or something. Right? So we're this little tiny company, and you know, we do things that are unconventional, and nobody believed that we were selling stock to Fidelity and T. Rowe and you know every other major brand name mutual fund company. That's who our client base is, and that's who we sold it to. So that was, you know, that was visible, and so therefore sort of cool. And, yeah, that's a lot of pressure when you get somebody, you know, telling 10 million people every morning that they're back against you. But that was a fun deal.
Could you talk a little bit about the beginning of your experience as an investment banker and what you'd recommend to college students who are interested in investment banking?
Sure. You know, I sort of, you know, because I didn't start with the investment banking firm right out of school, I sort of went the commercial banking route. You know, my experience is a little different, but and honestly, you know, it was I was probably not as dedicated as I should have been, and the world was a little bit different. Like, I mean, I never did an internship. I planted trees and dug holes for a landscaping company all through college and shined shoes, you know, when I was in school. So it wasn't like I had a really traditional path, but I did interview on campus, got a job, and it became clear. Definitely when I was down in Cincinnati, we were doing all the workout work for the bank down there, that I didn't want to just be a lender. That's a great job, and I've got a lot of friends that stayed on that path and they've done fantastically well. But I wanted. I wanted to work with CEOs, not treasurers. And so, you know, the CEO decision is about raising equity, and about selling another business or buying another business. The treasurer decision is about borrowing money. So when I got the opportunity to go into our capital markets or investment banking area at PNC, I took it like that. I mean, even though it was a startup business, right? Nobody had a securitization group yet. We knew that it was sort of the new financial technology, and I was just willing to do it because that was my way to get into the capital markets area. And then I just asked a lot of questions, right? And not just of people because since it was brand new, I was asking questions of lawyers and, you know, rating agency people. And, you know, it wasn't anybody inside of PNC at the time because, you know, we didn't have the technology. And I just sort of went from there. But it was really just because for whatever reason, I wanted to work with CEOs and not treasurers. In terms of, you know, how do you get there? Today, it's it's a pretty traditional route, right? I mean, people get internships between their junior and senior year. If they go well, you get an offer to come back, and for a long time, those were 2-year jobs if you were anything, right? So, and firms will tell you, look, you only work for 2 years, and then you have to go back to business school. I think because there's so much competition for talent with the technology industry today, a lot of that's gone away. So now if you go into one of those career pathway jobs and you do a good job, they want you to stay. Like, they don't want you to go back to business school because it's just too hard to find high quality people who are going to do a good job, who are going to work hard. And look, investment banking's version of work hard is, particularly the big firms, is not like work hard in the city. That's else. You hear all these stories and you read about stuff in the journal. A lot of that's true. One of the things I like about FDR is when we're in the middle of one of these big deals, the whole team is there 24/7, whatever it takes. And I've got a team working like that right now on this oilfield services deal. But when that deal's done, like if I don't see them for 3 weeks, that's perfectly fine with me. and I definitely don't, come in, Saturday at 3 o'clock just to sort of see who's in the office. And I don't let my head of investment banking do that or my head of equity research do that because I want people to have a life, right? And we can get away with that as a firm our size. The big firms, it's really hard work, but it's definitely, the traditional path is internship, get an offer, and now I think the good news is you can stay longer. I actually think, so as much as I'm not a private equity fan, I think the private equity firms today do a better job training than the investment banks do. So if that world is interesting, and I've seen a lot of people go sort of the opposite way over the last 5 or 10 years, where they started a private equity firm. The undergrads at private equity firms still get kicked out after 2 years because it's all the old guys who used to run the investment banks now work in private equity firms, and that's the way they sort of like to do things. And so, you can get in an analyst program at Blackstone or TPG or KKR, one of those firms. There's tons of them. It doesn't have to be only little firms like Crestview and others. And then you go back, get an MBA, and you come out, and I think you're more well prepared for the investment banking world. Sort of going the reverse route. For a long time, it was private equity guys recruiting from the capital markets or broker dealer firms. Now it's sort of flipped around a little bit. But we hire people that don't have finance backgrounds. Goldman hires people who don't have finance backgrounds. So you don't have to have a finance undergrad. Because you guys know better than I do, my question doesn't have an undergraduate business school. Right? So, they're interested in people who are smart, motivated, care, want the job. I mean, it's no different than anything else. You may be competing against a little bit bigger pool. But I think if you are appropriately aggressive, nobody wants to get 100 emails, right? But if you're appropriately aggressive, you do a good job when you're communicating with people. Coming out of Northwestern, I think you should have every opportunity if that's the path you want to go down.
Thank you.
Could you maybe provide some more insight on IPOs and what the key factors companies need to or should consider before going public, and
Sure.
what the risks and benefits are of doing so?
Sure. So, I mean, the big benefit to going public is you have a lower cost of capital, right? So, public investors just expect a lower return than private investors do, and part of that's because of if I used to tell people all the time. If you want to understand the value of liquidity, this may not make sense to all you yet if you haven't taken finance courses or started investing or whatever. But if I told you that you could buy a bond from me that paid 3%, if you want to sell it tomorrow, you can sell it tomorrow, no problem. But that's the yield, 3%. And let's say it was a $1,000 bond, and I said to you, I'll sell you this other $1,000 bond. But you can't sell it for 3 years. How much do you have to get paid to own this bond? Are you going to do it for 3% if you can buy this one for 3% and you can sell it the next day? Right? Everybody's going to buy this bond. So do you have to get 4% for 3 years of liquidity? 5%? 6%? I don't know the answer, right? There is no answer. But it's definitely high, right? So that's why private investors require a higher return than public investors, right? It's purely a liquidity function. Now, there are other elements to it as well, but the reason people go public is because they want a lower cost of capital. And lower cost of capital allows you to make investment decisions on projects that your competitors can't if they have a higher cost of capital. So your ability to grow is much greater. Your ability to acquire other businesses, competitive businesses, is enhanced significantly if you have a lower cost of capital than other firms. And so going public is really all about economics, or should be. Now, I will tell you, there are some companies that go public for branding purposes. Right? When Facebook went public, it was way more about branding than it was cost of capital. And they're not the only example of that. But 5 years in, or whatever it's been, 6 years in, it's about economics today, whereas before it was about branding. In terms of the downside of being public is that you do start to have to manage to 90-day cycles. And most businesses do not lend themselves to 90-day cycles. When I say 90-day cycle, I'm talking about quarterly reporting, right? And so you've got a bunch of people, some of whom don't really know much about your business, but happen to own your stock. And if for whatever reason you underperform, or they perceive you underperform for a quarter, which is a nanosecond in business time, that could be a problem in terms of stock value. So if your stock goes down, all of a sudden you've lost the cost of capital advantage. So quarterly reporting is a big drawback. There are a lot of costs to being public now with Sarbanes-Oxley, which is a whole bunch of layer of regulation that came out of the bankruptcies of WorldCom and Enron, and some big companies that turned out to have fraudulent, it's fair to call it fraudulent accounting numbers. And so even a small company like us, we probably pay, I could probably take $4 million cost out if we're private. And that's a lot for a little company. And if you're IBM, I bet you're paying $60 million, maybe more, just to be public, for sort of the privilege of having a public stock. So there are real economic costs that come with it as well. And if you're a management team, there's just a whole bunch of distractions that come with being public, and more today than ever before. So, activist investors, most of whom don't know anything, you want to talk about cost that is useless, right? To fight with an activist investor, right? You're going to spend money on PR firms and law firms and everything else. And so there's just a whole bunch of things that come with being public that we take people public for a living, right? So I definitely think that the cost of capital advantage is worth it. But my really close friends who are CEOs, I tell them to think long and hard and make sure that they have some reason they need a lower cost of capital. Because it's not, I don't think anybody should grow up saying, I want to be CEO in public. Right? That is not something to aspire to. Aspire to running a really profitable company, aspire to running a fantastic nonprofit. Being CEO of a public company is not. The only people who want to do that are people who haven't done it before. And if you ask anybody who's doing it today, they would prefer to be private. But just from a capital advantage standpoint, you have to be public if you really want the best ability to grow your business and get an appropriate valuation for your business because of this liquidity thing that I talked about a minute ago.
Can you talk about your experience doing securitization when it first started? Because that's something we learned in classes. Pretty cool. You guys did a really hard of making that.
It was, honestly, looking back at it now, it was like the Wild, in financial terms, the Wild West. We were literally making stuff up, not, three of us sitting at the table, but between us, we had a law firm actually here in Chicago, Mayor Brown, who was one of the really early law firms to get deeply involved with asset-backed finance. And we had a couple of really good lawyers, and we would just, it was fun. We were just sort of throwing ideas up to see what would stick. We came up with the idea that you could use commercial paper to, own these assets. It didn't have to be, long-term bond structure. and we came up with how to do the interest rate swaps and credit hedges to make sure that the cash flows inside these trusts were protected. And, it was honestly for a while, from like 94 to 2000, it seemed like every single deal had some advancement in technology, not real technology, but advancement in sort of securities technology that was taking the cost of financing assets down. So it was a lot of fun. It was intellectually stimulating, and it got to the point where if you did a deal that looked exactly like the deal before, people were like, booing you by, well, we didn't have anything like that. People were, booing you by memo, right? Because you weren't sort of pushing the envelope. So there was a lot of sort of healthy, creative destruction going on around the structures that we used, and the different assets that could be applied to. I think the very first securitization of licensing revenue, it might have been for Eric Clapton. It was for one of the big musicians who had big licensing stream coming off of old songs that he had written and performed. I know Michael Jackson did one back then. I mean, it was like anything that wasn't nailed down, we were trying to securitize, and it was fun. But it was not, honestly, it was not as interesting to me anyway as the equity market, because you're still working with basic bond structures. Right? I mean, they're very low risk, and we were sort of pushing an inch at a time to expand not the risk but the efficiency of the financing. But understanding the value of the business from an equity perspective, again, everybody's different. To me, that's the most interesting thing in finance, and that's sort of why I'm in Andre. Well, guys, you were very generous to sit here on a Thursday night. Housing College Thursday night was the big night, so I appreciate you taking time out to come over.
Well, thank you very much.